Hello everyone, welcome back to my channel. I am Debbie Lee here with the White Samurai Investment Group today, and today we are going to be diving into a topic that I see hold countless of people back from financial freedom. And what is it, you ask? The systems and strategy, turning data into decisions. Specifically, we're going to explore how the wealthy invest with data rather than with emotion, and why not knowing where your money goes is costing you more money than you think. So, over the past year that I have been working at White Samurai, I have observed, spoken to, and even just witnessed quite a lot of regular people, regular working class people, like just try to save hard and try to just be so diligent, but sometimes even invest, like they just struggle to see any results. And why is that? The common denominator is simple. It's just that they're not using the data as a guiding system for their financial decisions. Instead, their decisions are often based on emotion or guesswork or incomplete information. I've also studied the behaviours of wealthy individuals and very successful investors, but the contrast is like so staggering. What separates these two classes is not necessarily more money or education or luck. It's literally just a systematic approach to decision making. One that does turn every piece of financial information into actionable steps. They understand the emotions like fear or impatience or the fear of missing out that can sabotage results, and they put systems in place to prevent that. They track every single dollar, they analyze all the trends and make decisions and adjustments based on insight rather than making any assumptions. When ordinary people ignore the numbers, whether it's not tracking their spending or avoiding portfolio reviews or even just reacting emotionally to the market swings, they unknowingly pay the hidden cost of inefficiency and missed opportunities. For an example, spending money without knowing where it goes creates small leaks in cash flow that grow over months and years. These invisible losses are not just money wasted. They represent the missed opportunities to invest and to grow and to compound the wealth. So today we will break down this into a couple of topics. Firstly, we'll be talking about how the wealthy use data, not emotion, to make all of their investment decisions. And secondly, the hidden cost of not knowing where your money goes, including a lot of practical ways that you can implement systems to track and optimize your finances. So hopefully by the end of this video, you will not only understand the principles that guide all of these wealthy investors, but also have concrete steps to start applying these strategies in your own life. This isn't about complicated spreadsheets or expensive software. It's just building very simple, repeatable systems that give you clarity and control. It's just about turning information into decisions so your money works smarter for you. all of that is once you start applying all of these systems and strategies, you'll notice something really amazing. All of the decisions become so much easier. Your stress reduces tenfold and your wealth building trajectory accelerates. So, before we get into the topics, I will get into a story. So, I want to say that I worked with someone called Emily. And Emily was like 34, I think. She was a single mum working 2 jobs to support her younger daughter. And she was determined to provide a better life. But despite earning a decent income, she always seemed to be living paycheck to paycheck, like literally every single week, every month. And she thought that she was saving enough, but when unexpected bills came up, all of these unexpected expenses, like stuff that she needed to get repaired done on her car, like hospital bills, like medical bills, everything, or even just like a broken washing machine that she had to get fixed. She was like literally constantly stressed. She also dabbled in investing, and a friend had suggested to her to buy some tech stocks. So she opened a brokerage account and started investing. And at first, it was exciting. She bought a few shares and she watched the stock prices rise and felt like she finally was taking control of her financial future. But unfortunately, that excitement didn't last. When the market dipped one week, Emily kind of panicked. She sold some shares, and because of all the headlines on all of her like social media, it felt like everyone was also crashing. The next month, when a trending stock appeared, she impulsively invested without looking at the company's fundamentals. So within some months, she realized that she was losing more money than she was gaining. But it's not that Emily didn't want to succeed, right? Obviously she did, but she was making decisions emotionally based on what she was presented with, but she wasn't visualizing this as just data. She had no system for tracking her money. She didn't even know exactly where her paycheck was going. Like, when I first met her, I asked her, I was like, where does all your money go? Like, can you just like list off all of the main things that your money goes to? And she was like, nope, couldn't tell you. So she didn't even know exactly where her paycheck was going each month. And all of her bills and subscriptions and like random purchases, it all built up and it was all like blended into one. She had no visibility and the stress was starting to affect her health and her confidence. Emphasis on her health. One day she stumbled across a seminar about financial systems and strategy. The speaker asked a simple question to the crowd. Do you know exactly where every dollar of your money goes? Emily realized the answer was no, but that question did stick with her. She realized she needed 2 things: clarity on her finances and a system for making data-driven investment decisions. So Emily overhauled, but she started small. She spent the first entire month just tracking all of her expenses. Where did she spend every single dollar? Like groceries or utilities or subscriptions, coffee, car maintenance, everything. She was shocked at what she found. Over like $400 a month was going towards forgotten subscriptions, impulsive purchases like clothing items, trendy clothing items, and small fees as well that might not have seemed like much, but it all added up to like $5,000 a year that she could have used to invest back into her accounts or just like saved. So the next step that Emily implemented was a simple system for her investments. She set clear rules. She would make sure to research a stock / whatever fund that she was investing into before she invested into it, and define a target price and acceptable risk level. And also never to make a decision based on what she was seeing online and all of the like hype around a fund or a company. She also scheduled monthly portfolio reviews to monitor performance using clear metrics like the return on investment, growth trends, and diversification ratios. So the first few months were a little bit challenging. She caught herself feeling the urge to panic sell when a stock dipped, but her system kept her on track. It kept her focused. She reviewed the fundamentals, checked her predefined criteria, and made rational decisions. So over the time that I was working with her, she became very calm and confident, knowing her strategy was grounded in data. By tracking all of her money, Emily also discovered that her hidden expenses weren't just lost money, they were missed opportunities as well. So she redirected, I think it was $400 a month towards investments and an emergency fund. And in just a year, this small but consistent change had created a very noticeable difference in her life. Her portfolio was growing very steadily. Her stress levels also had noticeably decreased, very noticeably, and she finally felt in control of her financial life. So Emily's transformation didn't just stop there. The combination of the data-driven investing and full financial awareness created a feedback loop that just fed off of each other. So the more that she tracked and analysed, the better her decisions became. She began exploring new investment opportunities, some in stocks, others small side ventures, all evaluated with the data and measured against her financial goals as well. So a year later, Emily looked back and she realized something crazy. She was like, the wealth that she was building wasn't just about the money in her accounts, it was about her confidence and discipline and all of the control that she had. By investing with the data and just looking at it as data and not as emotional. And knowing exactly where her money was going as well, she had created a system that would serve her for the rest of her life. A few hard couple of months, not even hard, it was just like she just had to train herself into getting into this habit, and just a small couple of months doing that, she would just kind of like set it and forget it for the rest of her life. So her story illustrates the core principles that wealthy investors use every day. Invest with data and not emotion. The panic and hype destroys wealth. Systematic decisions create compounding and growth. Number 2, you want to track your money because invisible leaks and untracked expenses silently drain wealth. And awareness creates opportunities as well. Number 3, build repeatable systems because consistency and discipline in turn ordinary income into extraordinary results. Emily's journey shows that anyone can break free from the paycheck to paycheck cycle. You don't need to earn more money, or you don't need to just like blindly take risks, or even just relying on luck. It's because it's not luck. Investing is not lucky. By implementing very simple structured systems, monitoring your money, and making data-driven investment decisions, ordinary people can transform their financial future. So that is leading us to topic number 1. You want to invest with data, not with emotion. So I will write that down. Data. Hopefully I'll remember to include everything that I write by the end of the video. So you want to invest with the data, not your emotions. So investing with emotion is one of the most common traps that ordinary people fall into, right? It's one of the fastest ways to sabotage wealth building. Panic and excitement can even being envious or jealous or fear of missing out on opportunities or just missing out in general drives countless poor financial decisions every day. But very wealthy investors and successful traders and very seasoned fund managers operate very differently. They make sure to invest with the data and not emotion. And this simple shift is what separates average portfolios from crazy, extraordinary ones. So today I want to just break this down completely so I show you what this looks like in practice and give you actionable steps to start investing the way that wealthy people do, the healthy way that wealthy people do. So, why do emotions sabotage investing? Let's start by understanding the problem. Human beings are wired to react emotionally When we see a stock drop, our instinct is to panic, right? When we hear about hot stock tips, we kind of feel the pressure to buy immediately. These reactions might feel normal, but in investing, they are quite dangerous. So think about this classic scenario. A stock that you own drops by 10%. The news is filled with stories about market crashes, and social media feed is just buzzing with everyone selling, and your anxiety spikes, right? Because you're like, what the, I should be selling too. Your emotional reaction is saying, sell now. I'll stop the loss of this negative stock. But is this really rational? Often the underlying data, the company's fundamentals, earning reports, and growth potential hasn't changed. You are reacting to emotion, not information. Selling in a panic is locking in losses and missing the long-term gains because you're taking your money out of that system. The data shows are profitable. So consider the opposite scenario, right? A new IPO is hyped as the next best thing. You feel a little bit of FOMO because everyone is talking about it. You invest without research or understanding the company's metrics at all. You don't even know what the company is actually. The stock prices tank later. You're frustrated and you're very discouraged. A very clear example of letting emotion lead decisions instead of a very structured analysis. These are very universal mistakes that I see very often every day. Ordinary investors think they're being strategic, but in reality, emotional investing often erodes wealth and prevents compounding from working in your favour. So, number 2, how the wealthy approach investing directly. Wealthy investors, fund managers, and portfolio analysts have a completely different mindset. They understand that investing is a data-driven process and their goal is to make high probability decisions rather than chasing excitement. So what do? They track every investment. The first principle is very simple. If you can't measure it, you can't manage it. Wealthy people track every asset they own, monitoring performance against very clear benchmarks. They use metrics like the return on investment, ROI, how much their money grows over time, the risk-adjusted returns, how much return they're getting for the level of risk taken, the diversification ratios. So ensuring they're not overly exposed to one sector or asset type. And tracking isn't just about numbers, it's about creating clarity for yourself. If a stock or a fund underperforms, they can see it immediately. They take informed action rather than relying on gut feelings. What else did they do? They analyze the data, not the headlines. So wealthy investors don't react to headlines or social media hype. They analyze earning reports, balance sheets, and market trends, and economic indicators as well. This might sound quite intimidating, but the principle is just very straightforward. Decisions are based on the evidence, not the noise. So if you can't provide receipts for anything, don't put your money in there. As an example, during a market downturn, many investors might panic and sell. The wealthy investors, on the other hand, just look at the data. Is this a temporary drop? Are the fundamentals intact? Often they buy more at discounted prices because the data indicates long-term growth potential. The difference? They act logically, not emotionally. They also use systems for consistency. One of the biggest advantages of wealthy investors is that they don't leave decisions to chance. They implement systems that standardize investing valuation and decision making. These systems might include pre-set rules for buying or selling based on metrics, scheduled portfolio reviews like monthly or quarterly, diversification thresholds to avoid overexposure, and automated investment contributes to reduce emotional timing errors. So, a system that ensures that decisions are repeatable, disciplined, and free from daily emotional swings. Okay, so just to make this a little bit more concrete, I guess, I will tell you about a case study. So this is about panic selling. So let's talk about John. So John is a working class investor. They bought a stock at $50, and within 2 weeks it dropped to $45. Oh my goodness, I lost $5. But John was panicking. The panic set in, he sold immediately, but 2 months later, the stock recovered back up to $60. His emotional reaction cost him $15 per share, a very preventable loss. Let's talk about someone called Sarah. So Sarah is a small investor. She bought the same stock at $50. And when it dropped to $45, she reviewed the quarterly earnings, the industry trends, and analyst projections. She found the drop was due to short-term marketing sentiment, not any of the fundamentals of that company. She held her shares even. She even put a little bit more money in, resulting in a gain of $10 per share over the next quarter. So both of these examples highlight the impact of data-driven mindsets versus very emotional reactions. So what are some practical steps to start investing with the data? Deb, how do I do it? So you don't need millions of dollars to start thinking like a wealthy investor. So here is how to implement a data-first approach. Number 1, track everything. How will I do that? I'll go here. Track everything. So you do want to track everything. You want to start by tracking your current investments, or if you don't have any, you want to implement this system when you do start investing. So you want to use something like Excel spreadsheet, or use a spreadsheet app or an investment platform that allows you to monitor the peak performance versus the benchmarks. Oh, pardon me. You want to make sure that you monitor the portfolio allocation and individual asset growth. Number 2, you want to set clear rules. That's a good one. Set clear rules. So, before you make any investments, you want to define your entry and exit criteria based on the data. As an example, maybe you only buy if the P/E ratio is below 20, or in return, you only want to make sure to sell if the return on investment drops below 5% over 3 months without the fundamentals changing. So you need to just set clear rules to reduce any emotional decisions. Number 3, you want to review periodically. Review periodically. Oops. So you want to schedule monthly or quarterly quarterly reviews. So you want to look at your investments with fresh eyes. Make sure that you're not hovering over it all the time. You want to evaluate the data points instead of how it's making you feel. You also want to ask yourself, is the asset performing as it's expected? Has the risk changed? Are there better opportunities elsewhere? Number 4, you want to think in probabilities. That's a good one. Think in probabilities. So wealthy investors don't expect guaranteed wins. Of course not. They think in probabilities, asking what's the likelihood of this investment will achieve 10% growth in the next year? What's the risk that I'm wrong? These mindsets reduce emotional reactions and help you weigh the decisions very rationally. So, number 5, you want to reduce any emotional triggers. Reduce emotional triggers. So finally, you want to just identify what triggers your impulsive decisions and make sure that you're avoid checking your investments daily. Just don't look at them every day. You can look at them every day, but get used to what you're seeing. If you're seeing very up and down data points every day it's changing, that's what you're going to expect every day. Or just zoom out. You want to set automatic contributions. You want to use stop loss or automated rules. So these systems prevent emotion from taking over your portfolio. Some advanced concepts that wealthy investors use for you to think like a wealthy investor, you can also learn advanced concepts that help make the data actionable. So you want to risk-adjusted returns. What does this mean? Not all returns are created equal. A 10% gain on a highly volatile asset is riskier than a 6% gain on a very steady asset. Wealthy investors calculate risk-adjusted return metrics like a Sharpe ratio to evaluate true performance. You want to look at the scenario analysis. So wealthy investors model different scenarios. What happens if interest rates rise, if inflation spikes, or if the whole entire sector collapses? They prepare strategies for each scenario, making sure to reduce panic when the conditions do change. What else do? They diversify metrics. Rather than spreading investments randomly, wealthy investors analyze correlations between assets. So this ensures diversification actually reduces risk rather than giving a false impression or a false sense of security. What else do? So some mindset shifts for data-driven investing are you want to just make sure that investing with data is not just a skill, it's a whole entire mindset shift. So you want to make sure to have patience over urgency. If you're thinking long term, if you're investing for your future, just think about it. You want to make sure that long-term thinking does beat chasing quick gains. You want to make sure that you are curious versus feeling fear. So you want to investigate why an asset performs the way that it does. And you want to discipline yourself as opposed to being impulsive. So systems replace gut decisions. You want to make sure that you're continuously learning over being very egotistical about mistakes or failure in general. So you want to accept mistakes as data points, not failures. So all of these mindset shifts reinforce the very practical steps and help ordinary investors transition to wealth building behaviors. So some common mistakes to avoid when it comes to investing with the data and not your emotions. Even when trying to invest with data, people do make mistakes. It's inevitable. We're human. That's what life is about. So some mistakes that might happen are some people ignore metrics and are investing based on a gut feeling. They might also react to all the headlines instead of the fundamentals, neglecting risk and overexposure to one sector, failing to review the portfolio regularly, but not too regularly. So, avoiding all of these mistakes just make sure that you ensure your data-driven approach is consistent and very effective. So, the beauty of investing with data is control and clarity. Instead of second-guessing yourself or panicking, you can act with confidence. Small, consistent, data-driven decisions compound into significant long-term wealth. This is why the wealthy can consistently outperform the average investor. They have a repeatable, rational system guiding their actions. So the main takeaways for this point are that emotions destroy wealth, but the data builds it. Track, measure, and review every investment. And build systems that reinforce rules and remove impulsivity. Think probabilistically, not with certainty. Mindset shifts like patience, curiosity, discipline are just as important as the data. So, this brings us to topic number 2, the hidden cost of not knowing where your money goes. So, let me write that down. Not knowing where okay. So, the hidden cost of not knowing where your money is going. Many people think that earning more automatically leads to wealth, which it doesn't. But the truth is, if you don't know where your money goes, you'll never control it. You'll never truly have control under your finances. Hidden costs, invisible leaks, and untracked spending can very quickly eat away at your financial progress. And most people don't even realize it. Today, we are going to be exploring why tracking your money is critical, and what the hidden costs are, and how you can build systems to gain clarity, control, and wealth, obviously. So, what are the invisible leaks that drain your wealth? Well, think about your typical month. You earn your paycheck, you pay your bills, maybe even save a little bit, and then after you save your money, you're like, oh, I can spend it. So then your whole entire paycheck's gone. Seems normal, right? But often hidden leaks do exist. The subscription services that you forget that you signed up for, small, repeatable, impulsive purchases like coffees 3 times a day if you're addicted to coffee, little sweet treats at the end of the day, maybe even apps and things or bank fees, ATM charges, or high interest credit card investments, unnecessary upgrades, or service add-ons. Like, individually, these expenses do seem very insignificant, but over time they accumulate into thousands of dollars wasted money that could have been invested or compounded or oops, where did that just go? So I forgot my point where I was going, sorry. The wealthy are acutely aware of these small drains. They monitor every dollar. They categorize it very intentionally. This awareness allows them to redirect money towards investment or strategic growth rather than letting it just sit there, slowly evaporating through all of the cracks and the unnoticed leaks. What is the opportunity cost for the price of ignorance, right? That's pretty much what it is. Every dollar that slips through the cracks carries an opportunity cost. It's not just lost money. It's potential income, potential investment and growth, and potential security that never even existed. So, as an example, imagine you spend $50 a week on miscellaneous purchases that you don't even track. That's $200 a month, $2,500 a year. If you invested that $2,500 in a diversified portfolio with at least like 7% return, in 10 years, it would grow to just over like just over $5,000. So, and that's just like one small leak. Multiply all of that by all the multiple leaks, and the hidden costs suddenly become very huge. So ordinary people rarely see this because they don't track anything. They're not tracking any of their spending systematically. The wealthy know this, and they act very accordingly. They measure and categorize and allocate every dollar to maximize efficiency and growth. So the hidden cost of not knowing where your money goes, it's not just financial, it's also very psychological. The lack of awareness creates stress and anxiety and a lot of indecision. Worrying about bills and cash flow, feeling behind compared to other, everyone around you. Avoiding investments because finances feel overwhelming. Stress impacts decision making. When people feel very uncertain, they make short-term reactive decisions instead of long-term strategic ones. This is a huge hidden cost. Lost opportunities and poor choices cause emotional strain, all because they weren't even aware of their actual financial picture. Wealthy individuals don't let this happen. They implement tracking systems and financial transparency, which reduces stress and allows them to make rational, confident decisions. So if the wealthy do it, why can't ordinary people do it? The key is systems. Systems take the stress and guesswork out of managing money. Here's how they do it. Step by step. You want to record every expense. Start by recording everything for at least like 30 days. Every coffee, subscription, grocery run should be tracked. Use a spreadsheet. And if you can't remember, just do an average amount. So whatever works consistently for you. You also want to categorize these expenses, breaking down all the expenses into their categories, like if they're necessary, if they're discretionary, if they are investments. This provides a lot of visibility into where your money's going and identifies areas for optimization. You want to, number 3, you want to identify all the leaks. Once you see the numbers, you can identify small recurring leaks. These are expenses that don't add meaningful value to your life, but they consume money that could be invested. Number 4, allocate strategically. So redirect the leaks and non-essential spending to investments, savings, wealth building activities, right? Automate this process if possible, whenever possible, wherever possible. Investment accounts or recurring savings plans, remove the temptation to spend first. Number 5, review monthly. Financial tracking is not just a one and done situation. You need to make sure that you're watching everything. You need to keep track of everything. So schedule monthly reviews, reconcile the accounts, evaluate progress, make some adjustments if needed. This ensures that continued awareness prevents all of the old leaks from creeping back in. So let me share a story. This is about someone called Lisa. So Lisa is 32 and she was a teacher. So she's a teacher. She earned a very solid salary, but she never seemed to save enough. She thought that her finances were fine until she tracked every expense for at least a month. She discovered her spending. She was spending nearly like $300 a month on subscriptions that she forgot that she had, plus another $200 on impulse purchases. By redirecting all of this money, $5,000 per month, into an index fund, she was able to build a growing investment portfolio in just a year. So over 10 years, if we just apply that same strategy, the same amount, if it all compounded at least like 7%, that would grow over $90,000 from all of the small leaks that she never even knew existed. $90,000. Insane. The lesson's very clear. Financial awareness unlocks wealth. Small, very hidden costs don't seem like much until you see the opportunity cost. So, tracking your money is not just about stopping the leaks, it's about turning data into decisions, just like the wealthy investors do. Once you know exactly where every dollar goes, you can identify which discretionary expenses are unnecessary, determine how much can be invested every month, allocate money to high growth or income generating assets, adjust spending in real time. This principle directly links investing with data. Your finances are no longer a guessing game. You know the numbers, understand the flow, and make informed strategic decisions consistently. So, understanding the hidden cost of untracked money requires a mindset shift. Clarity over ignorance. Don't assume you know where your money goes. Just measure it. Discipline over impulse. Small systems prevent wasted spending. So, clarity over ignorance. Discipline over impulse. Growth over comfort. Growth over comfort. So, allocating funds to investments is often uncomfortable but pays a huge dividend. We also want to make sure that patience is over instant gratification. Instant gratification. Hope I spelled that right. So, wealth accumulates over time through consistent, conscious allocation. When you combine awareness with data-driven investing, just like topic number 1, the two reinforce each other. Clarity fuels better decisions, and better decisions compound into wealth. So, even with awareness, people can make mistakes. So sometimes maybe they might make mistakes like tracking inconsistently or like only partly, ignoring small leaks because they don't matter, failing to redirect savings into further investment vehicles, or overcomplicating the system so you stop using them. And the solution is very simple. Repeatable systems that provide consistent insight without overwhelming you. So, what are the systems that you can implement today? Debbie, help me, how do I do it? So even beginners can just start building their financial awareness immediately. So what do you want to do? You want to use a simple spreadsheet or an app to log income and expenses daily, set automatic transfers to investment accounts and into savings. Review bank statements weekly to catch leaks early. Categorize spending for a full picture of financial health. And 5, monthly check-ins. Adjust allocations, cut unnecessary spending, and plan for future investments. All of these steps are scalable. As your portfolio grows, you can add more, like more advanced tracking tools, dashboards, and analysis. So, what's the point of this, Deb? So, the hidden cost of not knowing where your money goes is very enormous, but the benefits of awareness are equally massive. Reduced financial stress, improved decision making and confidence, faster wealth accumulation, that's the main one, and the ability to invest strategically and seize opportunities. So awareness transforms your financial life is the foundation for disciplined, data-driven investing. long-term growth and wealth-building habits that last a lifetime. The invisible leaks cost money and opportunity. Tracking your money builds clarity, confidence, and control, redirecting all the leaks to investments and savings for compounding growth. Monthly reviews ensure continued financial awareness, and combining tracking with data-driven investing creates a very powerful wealth-building system. So, if you made it this far, and if you want to learn how to build the systems and grow your wealth strategically, White Samurai Investment Group can help. They provide guidance and resources for tracking finances and building disciplined investment strategies, and also making decisions with clarity and confidence. So, if you're interested, just visit their website in the description box below. And I just want to say, before the end of this video, oops, I won't forget to hold up all of the points. There we go. Cool. So, wealthy individuals succeed because they invest with data, not their emotions. And they track every dollar to avoid all of the hidden costs. Ordinary people can adopt these principles. Build systems for financial awareness, track the cash flow, and make decisions based on facts rather than feelings. Small, consistent steps compound into real lasting wealth. So, thank you again for making it this far. Please don't forget to leave a like, comment on this video, and check out all my other videos on this channel where I discuss topics on financial freedom. And also, make sure to check out the White Samurai Investment Group YouTube and also their website as well for all your questions and guidance, or comment or message me or the team at White Samurai, and we will do our best to help. So thank you everyone for watching this video, and I will see you in the next one.